Welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. In our last video, we talked about the evolution of investing, particularly sustainable investing. We're going to continue that topic today. Joining me is Noreen Kazi, our Senior Portfolio Manager. Now, Noreen, when we think about sustainable investing, how might we best describe that?
Thank you, Paul. Sustainable investing is a term that's been used interchangeably with values investing, socially responsible investing, but actually it has a much broader definition. Sustainable investing really incorporates the consideration of social, environmental, and governance factors into the whole investment decision-making process. It incorporates these factors along with traditional financial analysis when evaluating investments. The following graphic details some of these factors. So these categories are commonly referred to as ESG. As you can see in the environmental category, factors such as natural resource use, clean technology, and energy efficiency are taken into consideration. Social factors such as data security and privacy are prioritized. And finally, in the governance category, factors such as transparency and ethics are emphasized. Incorporating these ESG factors can potentially improve long-term investment results by helping to identify better managed companies that are capturing new opportunities and mitigating risk. It can also help flag companies likely to face headwinds due to evolving demographics, environmental, or regulatory trends. The next graphic will detail some of these opportunities and risks. As you can see, potential opportunities vary from resource usage to workforce diversity and clean technology. One example of this is the movement to electric vehicles, utilizing both clean tech and reduced emissions. And the identified risks vary from data security to extreme weather and health and safety. We see many of these issues being incorporated today in new infrastructure spending. These are just a couple of examples of the application of sustainable investing.
Noreen, that's a lot of really good information on sustainable investing. So how should we communicate to our clients how First Source is using sustainable investing and what opportunities we have available for our clients?
Sure, Paul. Sustainable investing in the U.S. has grown exponentially, especially over the last 5 years, driven mainly by public demand and interest. We have over $17 trillion in assets invested in this space currently, which makes up about a third of the total investments under management in the U.S. The next graphic details some of the methods of implementing sustainable investing. The three most common methods of incorporating sustainable investing are integration, values, and impact. ESG integration is the broad incorporation of ESG criteria across the board in the investment process with the goal of improving risk-adjusted returns. ESG criteria are considered as part of the normal portfolio management process, identifying risks, especially tail risks. In the value approach, it places emphasis on aligning investors' values and beliefs with their investments, including screening out non-aligned investments and including or overweighting investments that support their values. And finally, with impact investing, it attempts to deliver both investment returns and a positive impact by focusing on environmental or social themes that support long-term sustainability and provide an attractive long-term investment opportunity. Here at First Source, we have partnered with outside managers to implement integration, and we also work closely with individual clients to help them with their specific interests.
Noreen, we really appreciate those comments on sustainable investing. Now, if you truly have interest in learning more about sustainable investing, please reach out to us. We'd be glad to have that conversation, as Noreen said. As always, thank you for the opportunity to work with you and your family, and have a great day.